Welcome to Stress-Free Investing Analysis, Personal Notes, where we are doing a deep, fundamental dive into Dhabriya Polywood Limited. If you love finding those hidden gems in the stock market long before the big institutions catch on, you are absolutely going to find this explainer fascinating.
But first, a quick and very important note. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. Okay, here's our roadmap for today. We're going to move logically from understanding their core business model and moat right down to their recent financial inflection point. Then we'll dig into a massive valuation anomaly we've uncovered, cover the key risks you definitely need to watch, and finally, we'll land on a calculated investment verdict. Let's jump right in.
Section 1. Business Model and Moat. Before we get lost in the numbers, we really need to understand the business engine driving them. What exactly does this 327 crore rupee market cap company actually do?
So they operate under the brand Polywood and have actually been around since 1992. It's a battle-tested, founder-led company. When we break down their 235 crore rupee annual revenue, we see three distinct streams. Their highest margin segment, PVC profiles, is the real cash cow, driving 58% of the bulk. Then, making up 25%, we have uPVC windows and doors, which is their fast-growing institutional business. The remaining 17% comes from modular furniture. But why does this product mix matter? Applying the so what framework here, it really all comes down to their Save Trees ESG positioning. They are actively replacing imported natural wood in the construction sector. Think about the old paradigm. Natural wood means deforestation, heavy maintenance, and dealing with wood rot over time. Dhabriya's approach flips the script. They use a premium, rigid plastic alternative, uPVC. It's highly eco-friendly, incredibly weather-resistant, which is a massive advantage in their huge South Indian market, and uses absolutely zero natural wood. Premium real estate developers who are increasingly pushed toward green building norms absolutely love this. And that is exactly what's building their moat: genuine institutional trust. They aren't just selling to small local builders anymore. They're winning mega orders from industry giants like DLF and Godrej properties. They're currently sitting on a staggering 140+ crore rupee order book. That is roughly 60% of their entire FY25 revenue already locked in, giving them unbelievable revenue visibility going forward. They literally just bagged a massive 25.3 crore rupee single order from Godrej alone. This is a company rapidly transitioning into the big leagues. Section 2. Financial Inflection Point. Let's see how this exact premiumization strategy, shifting to high-end products like fluted panels and WPC doors, is creating a massive structural upgrade in their profitability. This is where things get incredibly exciting. Their core operating margins, or EBITDA, are just exploding. In a very short time frame, we've seen margins expand from 10% back in FY22 up to 16% in FY25 and hitting a whopping 21.1% in Q3 of FY26. Let me be clear, this isn't a one-off fluke. This is structural operating leverage kicking in, and that sheer margin expansion is driving an absolutely incredible 3-year net profit compound annual growth rate of 52%. They are growing their bottom line incredibly fast. But as stress-free investors, we know better than to just blindly trust top-line growth, right? We have to verify the quality of those earnings. Well, these quant scores are beautiful. A Piotrowski F score of 8 out of 9 points to tremendous overall financial health. Their Altman Z score is 5.46, putting them securely in the safe zone with zero near-term bankruptcy risk. And that negative Beanish M score? It proves there is practically no risk of accounting manipulation. They are making real, hard cash. Their impressive 20.4% return on capital employed is driven by genuine operational excellence and cash-backed earnings, not by dangerous leverage or accounting tricks. Fun fact, they've actually never diluted their equity since they incorporated. Section 3. The Valuation Anomaly. Now, with earnings growing at 52% and a totally pristine balance sheet, you would naturally expect a premium valuation, wouldn't you? The market usually prices these kinds of compounders expensively. But that brings us to the anomaly. 11.9 times, that is their current trailing 12-month price-to-earnings ratio, anchoring the stock price right now around 302 rupees.
For a company with this specific growth profile and massive margin expansion, a PE under 12 is almost unheard of.
To put that value into perspective, when you factor in their massive growth, their PEG ratio is a mere 0.38. Anything under 1 is generally considered undervalued, so we are looking at a massive value gap here. So what's the catch? Why is it priced so cheap? Honestly, it largely comes down to small cap illiquidity and a total lack of institutional research coverage. Big mutual funds simply cannot buy enough of a 327 crore market cap company to move the needle for their funds, so it flies completely under the radar. This is the exact kind of structural inefficiency that astute retail investors can capitalize on before the big institutions finally arrive.
Section 4. Key risks to watch. To build an airtight thesis, we have to look at the antithesis. We have to objectively tear down the red flags. No investment is perfect, and stress-free investing requires us to know exactly what could go wrong.
So here's what you need to keep an eye on. The most critical unresolved issue we found is why the promoters inexplicably sold a 6.47% stake back in September 2023. It dropped their holding from over 74% to about 67.7%. While it's remained perfectly stable since, the lack of explanation is a yellow flag we need to monitor. Secondly, they have a major capex cycle coming up. They're planning to spend 50 to 60 crore rupees over the next 2 to 3 years. That will absolutely pressure their free cash flow in the near term. And finally, liquidity risk. The daily trading volume is only between 20 to 50 lakh rupees. Because of the wide bid-ask spreads, it can be really dangerous to build large positions quickly, or worse, try to exit in a panic.
Section 5. Final Investment Verdict. Let's synthesize all of this. We've got tremendous fundamental upside, massive order visibility, and a screamingly cheap valuation. But we also have genuine liquidity and governance questions to respect. Let's land on a calculated verdict.
Think about the profound asymmetry we have here. Even in our bear case scenario, where let's say margins compress and growth slows down, we see a downside risk to 180 rupees, which is roughly a 40% drop. But look at the base case. Assuming they just meet management's own 25% growth guidance, we're targeting 500 rupees. That's a 66% upside. And in a bull case, where margins sustain above 22% and the market eventually re-rates that PE multiple, we could easily see 700 rupees or 132% upside. Our discounted cash flow analysis shows an intrinsic value sitting comfortably between 368 and 460 rupees. That means the current market price of 302 is offering us a very heavy margin of safety.
Ultimately, Dhabriya Polywood earns a very strong final score of 80 out of 100. That is a grade B, buy or accumulate rating. But remember, execution is everything. The strategy here is to stagger your entry below 320 rupees, ideally catching the dips near that 280 rupee support level. Crucially, you must limit your position size to a maximum of 1% to 2% of your portfolio to manage that small cap liquidity risk we just discussed. If you respect a hard stop loss at 220 rupees, this company presents a rare, highly asymmetric risk-reward ratio for the patient investor. It really leaves us with a fascinating question to ponder. In a market completely obsessed with overvalued large caps, are under-the-radar structural upgrades like this the last true safe havens for retail investors?
Before we wrap up, a quick but important disclaimer. The analysis shared in this explainer is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next explainer. Thank you for watching, and keep your investing stress-free investing.